Good afternoon. My name is Emmanuel Arreola, and I'll be speaking to you on behalf of Apollo Inc. Currently at Apollo Inc., I serve as the Chief Marketing Officer, and I'll be giving you a brief introduction to our past results of our company in this class of Management 497 capstone. Just briefly, Apollo functioned in the World 18 as company number 4, and our position was to excel as both a production and distribution company of finished goods in specific markets. Currently, Apollo is striving to be a leader in the niche market category, where we did not focus on market share, but on 3 critical weighting factors in stock price, return on equity, and total net income. The reason for this was because a niche market does not need market share, therefore giving us a chance to specialize in our products via offering the newest model earlier than our competition at premium prices. This allowed us to have leeway by not having to produce as many units while still calculating in the first or second position as far as revenue. Also, spending a lot of money in allocation of research and development and training expenses, we were able to enforce our sales force as pushing our product to the specific market where these qualities and features are most desired. Also, our goals at the beginning of the quarter were met as far as having the highest return on equity to reward our stakeholders and make it profitable as early as possible and setting a foundation for the future. And lastly, the stock price to be able to pay out dividends to those stockholders and be able to repurchase stocks to be able to effectively borrow money for future endeavors. In closing, we'll be speaking to you about pro formas, income sheets, and our comparisons as far as forecasts go for each of those matters, and we'll hand it off to the next person on our executive board. Thank you.
My name is Kenneth Chang, and I'm the Chief Operation Officer of the company, Apollo. And right now, I'm doing the industry analysis based on industry sales, market shares, and stock price. So first we talk about industry sales. When we see the graph, we can see the sales in year 5 and year 6 are stable in the average of 6 million. Team 1 has started to dominate the total sales in year 5, quarter 4 due to their high advertisement and low price. Team 2 has the same result with us, that their sales are pretty much average around 6 million as well. Team 3 had an average around 4 million for the first 3 quarters. However, during the quarter 4, they have raised their sales into 6 million and become a little more competitive. There are a couple reasons to explain the stability of our sales. First of all, we have a pretty fixed set of price. Also, because of our level production plan, the amount of product we produce is pretty much the same. Second of all, we have moved all our industry into Pandao, which will minor affect the change sales. For example, the unit production cost was stable around 3.5 because we have only opening firms in Pandao. It's much easier to control the cost if it is only. Okay, now we'll talk about the stock price. Basically, as you see, Team 1 is, actually Team 4, our company, has a pretty high competitive advantage among other 3 teams. But during the year 5, quarter 2, we stopped having a decline in the stock price. And however, for Team 1, actually started have an increase start from year 6, quarter 1. And actually, Team 2 and Team 3 are actually not as competitive compared with us and Team 1. And I need to get an explanation of why we are having a decline from year 5, quarter 2 and from year 5, quarter 3. First of all, we have brought back 835,000 of our stock and raised the ROI from 4.9 to 38.7. And also, we have issued more dividends in year 5, quarter 2, comparing with previous quarter from 100,000 to 250,000. However, the continuously purchase of our stock caused the stock value to be declined in year 5, quarter 3, and market share has dropped. Now we're going to do an analysis about market share. As you can see, for our team, we have a very stable market share between 20 to 25%. And then look at our competitors, Team 1. They have a 30% above from year 5 and almost reached to 40% on year 6, quarter 4. And the reason for this explanation is because for their production, they have set up very, very low prices, and they are manageable to actually sell very, very high quantity of the goods. And in that case, the result will be having a very, very high market.
Hi, my name is Mylin with Apollo Inc. and I'm treasurer. I would like to talk about today net income, ROA and ROE, and comparing it to the rest of the industry. As for net income, from year 5, quarter 1 to year 6, quarter 1, we see that net income is really unstable. This is probably because of the operating expenses stably going up and revenue is kind of unstable up and down, and that's probably because of seasonality. As for year 6, quarter 1, that's right here. That's the lowest point of our net income, and it's not so bad because we're almost kind of the same as as team 2, and we're way above team 3, but team 1 is still dominating us throughout those years. And also a point that I want to mention is year 5, quarter 3. That's when we start to fall behind of team 1. But on a positive light, when we look at year 6, quarter 1, which is right here, we start to kind of go up and catch up with team 1. Okay. Now I'm going to talk about ROA. Basically, we all know that return on assets is the ratio from net income to assets. And as you can see from the graph, here's team 4, which is right here, that's us. And it goes like that, up. And we know that, as you can see from the graph, our ROA figures are very volatile. And we can also see that from year 5, quarter 3, right here, this is team 4, this is team 1, which is us, that's us. We're ahead of them at ROA, but from that point on, we start to fall behind. That's probably because of the increase in net income mentioned earlier from team 1. And at our lowest point from year 6, quarter 3, so year 6, quarter 1, that's our lowest point. That's also because of our net income at that year and quarter. And at the last part of year 6, around year 6, quarter 3 to 4, we see that we increase a lot in ROA, and we kind of catch up to team 1. And at that point, you can also see a separation of competition between us and team 1 and teams 2 and 3, which are okay. Now I'm going to talk about ROE, which is return on equity. As we all know, ROE is how much net income is generated per dollar of equity. Just like ROA, our ROE is similarly volatile. And when we look at team 1, which is right here, they're actually almost as volatile as us. And up until year 5, quarter 4, which is right here, we actually dominate them in ROE. But as discussed earlier, in this quarter, we actually had a really low net income, which triggers our low ROE. And when we look at our peaks, which is year 5, quarter 2, right here, all the way up there, we actually beat the whole industry in ROE. And this is probably explained by the increase in net income and decrease in equity. We believe our equity decreased because of the repurchase of stock that we did in that quarter, which is year 5, quarter 2.